All right, let's talk about the 5 core calculations that are going to be the absolute bedrock of your career as a mortgage loan originator. Mastering these isn't just about passing a test. It's really about becoming that trusted advisor who can confidently guide people through one of the biggest financial decisions of their entire lives. It's easy to think of these as just, dry formulas, but they're not. They're actually the keys to unlocking client trust. When you can speak the language of lending fluently, you can set clear expectations, you can build real rapport, and ultimately, you're going to build a much more successful career. So I guess the real question is, are you fluent in this language yet? Let's find out. We're going to master the essentials that you will literally be using every single day on the job. Okay, let's dive right in with the 2 big ones, the foundational pillars of qualifying any borrower: loan to value and debt to income. Trust me, these 2 numbers will shape the story of every single loan application that comes across your desk. First up, LTV. So what is it really? At its heart, it's just a measure of risk. It's one single percentage that tells the lender how much skin they have in the game and how much equity the borrower has from day one. So how do you actually calculate this for a client? It's super simple, really just 3 steps. First, you start with the property's value. Let's say it's $500,000. Then you subtract their down payment, 75 grand in this case, which gives you a loan amount of $425,000. And then you just divide that loan amount by the property's value. That's it. In our example, that simple division gives you 0.85 or an 85% LTV. This number right here, it's the key that unlocks pretty much everything else about the loan. And this is where it gets really interesting, because that one number has this huge domino effect. See, a lower LTV means less risk for the lender, and that usually means better interest rates for your client. But a higher LTV, like our 85% example, well, that's a red flag for lenders, and it almost always means they're going to require private mortgage insurance, which we're going to get to in a minute. This is just a perfect way to think about the difference between LTV and the next number we're going to talk about. If LTV is all about the risk tied to the property, DTI is all about the risk tied to the borrower. So let's talk DTI. This is what builds the other half of that qualification picture. This ratio tells a lender exactly what chunk of a borrower's monthly income is already spoken for before they even think about the mortgage. To figure it out, we just add up all their recurring monthly debts. So for our guy Marcus, that's his car loan, his student loan, his credit cards. And here's the really crucial part. You have to include the proposed new mortgage payment. That brings his total monthly debt to $2,750. Then you take that total debt and you divide it by his gross monthly income, which is $7,000. And that gives us a debt-to-income ratio of 39%. So why does this number matter so much? Well, this is basically the lender's affordability gauge. It's the main way they figure out if a borrower can actually handle this new payment. Generally, you want to see a DTI under 43 to 45% for most conventional loans. Get it lower than that, and you can often unlock even better terms for your client. Okay, let's tackle a topic that honestly confuses and frustrates a lot of borrowers: private mortgage insurance, or PMI. Your ability to explain this clearly is a total game changer. Your job here is to make this super simple. You tell them, look, PMI isn't for you. It's an insurance policy that protects the lender just in case you stop paying. It's required anytime the LTV is over 80%, because from the lender's point of view, they're taking on more risk. The math to figure out the monthly cost is actually a breeze. You just take the loan amount, multiply it by the PMI rate, which can vary, but we'll use a common one, 0.55%, and that gives you the annual cost. Then just divide that by 12. So for our loan, that adds an extra $194.79 to the monthly payment. When you can calculate this on the fly, you're showing your client the real-world cost of their down payment choice right then and there. I guarantee this will be the #1 question you get about PMI, and answering it with confidence makes you look like a rock star. The simple answer is they can request to have it removed once their loan balance hits 80% of the home's original value. And even better, the law says it has to automatically drop off once they hit 78%. All right, let's head to the closing table. This is where a lot of anxiety can pop up if your borrower sees numbers they don't expect. So we're going to demystify 2 of the most common costs they'll run into: per diem interest and points. First up, per diem interest.
To a borrower who isn't prepared, this can look like some totally random fee that got tacked on at the last minute. But it actually makes perfect sense. And this shows you exactly what's going on. If you close on, say, April 23rd, you're just prepaying the interest for those last 8 days of April right there at the closing table. That way, your very first mortgage payment starts fresh on June 1st, covering the month of May. It's really just prepaid interest.
Next up, points. Now, you should think of these as a powerful tool in your kit. They help your clients lower their monthly payment over the long haul. Basically, they're paying a fee up front to buy down their interest rate. And the rule is simple. 1 point always equals 1% of the loan amount.
But here's the real question you have to help your client answer. Is it a good deal? This is where your expertise shines. You calculate the break-even point. Just divide the upfront cost by the monthly savings, and you can show them exactly when that investment starts paying off. In this case, after 50 months, that $70 a month is pure savings.
So, we've gone through the what and the how of all these calculations. But to wrap this up, let's focus on the most important part, the why. Why is it so critical for you to master this math? Because look, at the end of the day, anyone can punch numbers into a calculator. But your ability to translate those numbers into a story that makes sense to your client, that is what separates a good MLO from a great one. And that's what turns a single transaction into a career built on trust and referrals for years to come.